Welcome to Today Finance at Sketching Finance. I'm James, bringing you the latest market updates and expert analysis. Let's dive in. Market cap is basically the stock market's way of saying, how big is this company? But here's the problem. Big doesn't always mean strong. Sometimes it's a solid ship made of steel, and sometimes it's just a giant balloon. So today, we'll learn how to spot the difference. Because if you can tell whether a market cap is backed by real business strength or just hype, you'll avoid a lot of painful beginner mistakes. Let's start with the one formula everyone should know. Market cap equals the stock price times the number of shares out there. Super simple, but it can hide some big risks. Here's a quick picture. If the stock price goes up, market cap goes up too, even if the actual business hasn't changed much. That's how people end up buying something that looks bigger but isn't truly better. Pros usually ask, is this move coming from stronger fundamentals or from investors paying a higher price for the same fundamentals? Those are totally different situations. In this video, we'll use 5 simple questions to judge market cap like an analyst. It's not about being perfect. It's about having a repeatable process so you don't get tricked by the market's mood. Here's a really helpful way to think about price. Price is basically a multiple times fundamentals. So if earnings grow, the price can grow for a healthy reason. But if the multiple expands, the price can rise even if the business doesn't improve much. Aswath Damodaran, a famous valuation professor at NYU, says markets live where numbers meet stories. Stories move prices fast, but over time, cash flow has to catch up. Our goal is to figure out how much of today's value is real and how much is just story. In the US, market cap also tells you something about behavior. Large caps are usually more stable and easier to trade. Mid caps can grow faster. Small caps can move like crazy, up or down, because they're more sensitive to news and investor emotion. So we're going to connect all of this into one simple decision system. You'll know what to check in filings, earnings reports, and trading data without drowning in complicated finance jargon. Question 1. Why did market cap go up? A great way to break it down is this. Market cap can change because fundamentals improved, because the valuation multiple got bigger, or because the number of shares changed. Here's the healthy example. If a company grows earnings a lot over 2 years and the PE stays about the same, the market cap rises for a solid reason. The business is actually producing more profit. Now here's the riskier example. If earnings barely grow, but the PE shoots up, the market cap can explode upward, mostly because investors got excited. That can happen in hype cycles, like AI hype, rate cut hype, or momentum trading. And to be clear, hype doesn't always mean it's wrong, but it does mean you're paying today for a future you haven't seen yet. So you need real evidence that future growth can actually show up. Question 2. Is dilution quietly working against you? In the US, lots of companies pay employees with stock. That sounds fine, until you realize it can increase the number of shares and shrink your ownership over time. So you want to look at fully diluted shares, not just basic shares. Fully diluted means you're counting things like employee stock, options, and convertibles that can turn into real shares later. Now, buybacks can help because they reduce shares. But here's the catch. Sometimes buybacks only cancel out dilution from stock compensation. So it looks shareholder-friendly, but shares don't really go down much. Quick beginner checklist. Look at the share count over the last 3 years, check stock-based compensation compared to revenue, and look at diluted EPS notes. If dilution is heavy, you need either stronger cash flow growth or a lower price. Question 3. Does the company's market cap match its stage of growth? Businesses usually go through phases. Early stage grab market share, then scaling, then mature, steady cash flow. In the early stage, companies often burn cash. In scaling, margins improve because the business gets more efficient as it grows. In the mature stage, cash flow becomes steady, and investors often care more about dividends and buybacks. A lot of companies love talking about a giant TAM, total addressable market. But TAM is not money in your pocket. What matters is, can they actually win customers profitably at a reasonable cost? This is why cash flow is so important. Free cash flow is operating cash flow minus CapEx. And a great quality check is cash conversion. Free cash flow divided by net income. If earnings look great but cash is weak, something's off. Question 4. Can you actually trade this stock safely? Some stocks, especially small caps, have low liquidity. That means wider spreads, more price slippage, and bigger drops when people rush to sell. 2 simple tools. Dollar volume, which is price times daily volume, and spread percent, which is basically the trading fee hidden inside the bid-ask spread. If dollar volume is low and spreads are wide, you should treat it as high risk. Low liquidity also makes manipulation easier, things like pump and dump patterns. If the price is flying but the fundamentals aren't changing, you should assume the move might not be for your benefit. By the way, if you're enjoying this kind of simple, real-world investing breakdown, subscribe to Sketching Finance. We keep things beginner-friendly, but we don't skip the important stuff. Question 5 is the big one. Where does this stock belong in your portfolio? For most beginners, large caps or broad index funds work well as the core because they're easier to hold through rough markets. Here are 2 simple example setups. Conservative might be 80% large cap, 15% mid cap, 5% small cap. Growth-focused might be 60% large, 30% mid, 10% small. The exact numbers matter less than the idea. Control your risk. Let's lock in the checklist. 1. Break market cap changes into fundamentals, multiples, and shares. 2. Check dilution. 3. Figure out the growth stage and whether margins and cash are improving. 4. Check liquidity using dollar volume and spreads. And 5. Decide if it's core or satellite, then size it appropriately. Investing isn't just picking winners. It's building a portfolio that survives mistakes and market chaos. One big beginner mistake is going too big on a risky stock. If something is volatile or illiquid, you reduce the position size. That's not being scared, that's being smart. Here's a simple sizing idea. Position size is roughly your max loss per idea, divided by how much the stock could drop before you exit. If you only want to risk 1% of your portfolio and the stock can easily drop 20%, your position must be much smaller. Quick recap. Market cap is a tool, not a trophy. Ask the 5 questions. What's driving it? Is dilution hiding risk? What growth stage is it in? Is liquidity safe? And where does it fit in your portfolio? Investing legends talk about the margin of safety and risk you can't see. These 5 questions help you see the hidden stuff, so you're not shocked when the market mood flips. If you want a simple checklist version of this framework, comment market cap below. And subscribe to Sketching Finance. It helps a lot, and it tells me to keep making videos like this. Next time, we'll go deeper with enterprise value, because 2 companies can have the same market cap but totally different debt and cash realities. See you in the next sketch. Invest like an owner, not a gambler.